Well, joining us now is Tim Evans from Longleaf Trading Group. He joins us from the CME in Chicago. Hello to you. Let's start firstly with a look at those oil moves. We have seen it slipping back. OPEC very much in focus. What are you making of it on the ground over there?
Hi, good morning to you, Natalie. Yeah, you know, it's OPEC, the news relating to OPEC has really been driving this market. You know, obviously, you know, earlier this week and late last week, there were some positive developments in terms of a much stronger likelihood that, you know, OPEC's going to be able to come to some agreement that could possibly be enforceable. You know, there's been some chatter today that, you know, are indicating maybe some complications with Iran, Iraq. So we've seen a very small setback, but you know, obviously, if you kind of look at this event as a binomial event, the market is pricing in a greater probability that OPEC is actually able to move forward with a deal on November 30th.
Well, naturally, it's not just that OPEC meeting in focus, but also the December meeting from the US Fed. Now, if we take a look with bonds and bets and really what traders are pricing in there. Traders now certain of action from the Federal Reserve in December. And in fact, we have a chart which I'd love to show viewers, really looking at how that bonds and bets are very much in focus and pricing in a 100% chance of a hike in December versus the 95% that we saw last Monday. And also looking ahead, traders seeing a 53% chance of the Fed raising rates to at least 0.75 to 1% in June. Little changed again from Monday. And if we've got also, you know, a chart looking at, in the white line of this graph, we can see the odds of a 2016 Fed hike, and the blue line for viewers is also the 2-year Treasury yield. So really, it would seem, Tim, that it is a done deal. Again, how is this shaping sentiment over there on Wall Street?
Well, I think the market, I think, is observing the fact that the Fed is in a much better position being able to move forward with a rate hike. And that's why we're seeing 100% probability priced in. You know, because there were times here over the last 3 or 4 months going into those Fed meetings where it was seeming likely. We would hear hawkish statements, you know, all the numbers that would be that were released kind of going into that meeting would be positive. And then it seemed like all of a sudden going into that last week into the meeting, numbers would turn over, they would sour, you know, and then the Fed wasn't in a strong position to go ahead and raise rates. I mean, they were afraid that they were going to see that they were going to be a contractionary force that could possibly tip us back over into another recession. You know, we always have to remember that fiscal policy plays a very critical role in stimulating economies. It's not just monetary policy. It seems that way because that's all we've really focused on for the last, 7, 8 years. But with Trump's proposed policies, and at least what the market believes that we'll be seeing under a Trump administration, fiscal policy is going to be a major tool. You know, we're looking at a lot of spending in the form of infrastructure spending. We're looking at stimulus in the form of individual income tax rates being pulled back, corporate tax rates being pulled back. You know, so that really, it takes a lot of the burden off the shoulders of the Fed where they can actually move forward with the rate hike and it won't be contractionary because there will be kind of an offsetting balance given by Trump administration fiscal policy.
What impact then is that steadying US dollar that we've seen in overnight trade having on markets and I guess particularly US Treasuries?
I mean, the stronger dollar in terms of, overall market, I don't think that there's a cause and effect relationship that's really taking place. I think there's an expression of confidence in the American economy. And that means American assets are being purchased. We're seeing obviously U.S. stocks, all 4 major stock indices hitting record levels. That's the first time that's actually happened since the last trading day of 1999, which was in the heart of the top of the dot-com bubble. I'm hoping it's not going to end that way this time around, but it's an expression of confidence, and that's filtering through all markets, including the currency space.
But if we consider the knock-on impact of that rising Australian dollar, then small cap companies kind of really spring to mind somewhat. Again, what impact is this having there? And also, what sort of level of performance have we seen in some of those small cap stocks?
Yeah, I mean, small cap stocks, I mean, they're, in my view, very positioned to do very well. I mean, and I think if you look at the stock index space on a spread basis, my expectation is, that the Russell 2000 will most likely outperform the S&P or Dow or NASDAQ, and that's because it's comprised primarily of small cap companies. Small cap companies are normally, and it's not always the case, but by and large, they're smaller companies that are focused on U.S. production and consumed in the United States. Kind of this America First idea that, Trump, President-elect Trump is promoting and most, expect to see when he takes office, are positioned to benefit those exact companies. He's looking to, promote the idea of American products being produced here and consumed here. So those companies, the bigger cap companies that are multinationals and rely on import-export for profitability are not going to be, on a relative basis, positioned to do as well as these small caps.
Well, part of this whole Trumponomics idea is also the expectation of higher inflation levels also. Now, gold has been bouncing around really in the wake of that US election, but doesn't really seem to be as correlated to the idea of rising inflation as historically it would be.
Yeah, I personally, I'm looking at gold as potentially the best cyclical opportunity on the board. We've seen the gold pull back sharply. The night of the election, we had that big rally and then the big turnover, and it sold off aggressively. The idea being that, the concern of a Trump administration no longer was a concern and, good times were ahead. Therefore, there's no reason to buy gold as a safe haven. We have to always remember, though, gold is not only a safe haven market. I mean, gold historically has performed best in times of inflation. As they took the U.S. dollar off the gold standard and continue to print dollars with, really no net change in the supply of gold, the value of gold went higher. What the market is pricing in, if the market has it right and we ultimately end up seeing inflation, gold is going to be the primary beneficiary of that. So, I mean, my view as gold is pulling back, as these safe haven holders of gold are selling off of those positions, transitioning into something else, which is bringing that price lower, I think it's providing a very good opportunity to buy gold at discounted prices, positioning for potential inflation down the road.
Tim, thank you so much for your time. Yep, expectations that gold price volatility could continue on Trump cabinet news as that sort of continues to come out. Tim, thank you so much for your comments. We'll chat with you again soon.
Thank you, Natalie.